Okay, hey guys, good morning in this wonderful Saturday or Sunday morning. So welcome to our video lectures. So I would like to keep the video as short as possible. So maybe today's lecture is 1 hour lectures. So let's get started. So let me share screen. So today's video lecture is talking about the investor preference. So before that, let me quickly review what we have learned in the previous online lectures. So we discussed about the difference of the realized return and expected return. You need to recognize the difference. So the realized return can be positive and can be negative, but for the expected return, it should be positive because it's the return expected by investor before they make any investment. And the second one is that you need to being able to describe the following principle. The first one, so this is very, very important. So you need to keep this in mind, I wish forever. So this equation tells us that the expected return of any financial asset R equals risk-free interest rate plus risk premiums. So if one asset is kind of risk-free, then you can expect the return for the following year should be RF, which is the risk-free interest rate. If this asset has more or less risk, then you will require risk premium. So in this sense, the risky access expected return should be higher than risk-free access expected return, or RF. So the difference between the expected return of a financial asset and risk-free interest rate is called risk premiums. And the second principle is that we introduced a real-life example about a part-time job. So I think this logic can apply to financial assets. So financial assets with identical risks, they should have the same expected return. And the third principle is kind of maybe at the beginning it's difficult to understand, but it says that the price of any financial asset equal to the present value of all its future cash flow. You can imagine the bank deposits, okay? You deposit your money and you get a bank book, and this is your financial assets. And 1 year later, you get paid. So once you can remember this example, I think it's easy to remember this principle. And finally, we discussed why corporate finance is closely related to investment strategy, because we discussed the concept of opportunity cost and cost of capital. So if you forget all those concepts, please kindly review the previous material. So okay, today's contents is quite simple. We just need to discuss different type of investors. One is risk averse. Risk averse investor means the investor hate risks. And we also have risk neutral. He don't care risks. And the final one is risk lover, who likes taking risks or seeking for risks. So why will we need to discuss risk different type of investor? Because this course is teaching, we're going to learn about the strategy, which are optimal for the investors. However, it's difficult to make a conclusion regarding what are the optimal strategy without a clear assumption which type of investor are you referring to. So some investor might be risk-taking investor, maybe they have different strategy for those risk-taking investors. And we also have risk-averse and risk-neutral investor. So based on discussion, we need to first understand what's the difference between each type of investors. And importantly, in the following 2 to 3 online lectures covering portfolio theory, we need to build our theory on assumption that investors are risk averse. So that's the reason why we need to have this video lecture covering the type of investors. So basically, we start by risk averse and go to risk neutral and go to risk averse. Okay, so let's first see the definition of risk averse investor. So risk averse, as the word say, investor hates risks. So to be more specific, when the expected return is the same, risk-averse investor would choose the one whose risk is lower. Or in other words, a simple example is there are two financial assets provided to risk-averse investors. One is total risk-free, and its expected return is 5%. Another one is risky, very risky, and its expected return is also 5%. So based on this principle, so risk-averse investor should prefer the one with the lower risk, given the same level of expected return, 5%. And we can also think in turning around. So we can describe risk-averse investor in a different way. That is this one. So when the risk is the same, so the investor would choose the one whose expected return is higher. I think that the two sentences are just like the two side of a coin. So basically, we are talking about the risk-averse investor. They hate risks. Okay, so we're gonna go to the example in the a couple of slides later. So next one is about risk-neutral investors. So this type of investors who think about investment only with the expected return. So I think as investors, so you need to, when you need to make your investment decision, you need to consider a lot of factors. For example, the risks of the investment and the expected return of this investment. And also, if you are elder people, you also need to wish you can get this kind of stable cash, like you can get monthly dividend payment to live a living. So yes, investors need to consider a lot of factors, but I think two of the most important factors are risk and expected return. So which is different with the risk-averse investors. Risk-neutral investor, they only care about expected return. So for us, to give a simple example, that if there's a risk-free asset, let's say it's government bond, the expected return is 5%. And that's another asset, which is risky. So I mean, when I say risky, means that their return can be positive, can be negative. There's a potential up and down. And on average, its expected return is also 5%. So based on previous discussion, risk-averse investor, they would prefer risk-free asset given the same level of expected return. because they hate risks. On the other hand, the risk-neutral investors, they are indifferent between the risk-free asset and the risky asset, as long as they can provide the same expected return. So to sum up, when the expected return is the same, the satisfaction coming from this investment is identical for risk-neutral investor. Okay, the final one is the risk lovers. So when the expected return is the same, this type of investor prefer the risky one. So for example, so if you put your money in the bank, maybe you have 1% of return, I mean the annual return. On the other hand, if you buy lottery, I think the expected return should be very, very low, right? But you still want to buy it. So what does this mean? So this means that even though the risky asset, lottery, provide lower expected return than the risk-free asset, you still prefer this one. So in this case, this investor can be classified as risk lovers. So I think after introduction of the definition of the three kind of investor, you might feel a little bit confused. So let's see some example to clarify my point. Okay. So before the two example, I would like you to watch these two short video. I think it's really short, 1 to 2 minutes video for these two concepts, risk averse and risk seeking. Okay, please watch the video by yourself. Okay, now with this concept in mind, so the next thing is I would like you to do the following survey and put your result into response. So for the survey, you can access to the survey through the following link. For example, please go to the survey. So basically, it takes 1 minute to do some multiple choice question. Then they will tell you that what kind of investor you are. You can be aggressive, moderately conservative, and conservative. So based on your type, they will have some suggestion about your investment strategy. So after you finish the survey, okay, please kindly put your result into the response. So this is the numbers. So 270-833-587. Okay, so I am kind of looking forward to your survey result. Okay, then I just like to use a couple of simple examples to justify the concept of the three type of investors. So I would like to change my slide to iPad. So give me a second. Okay. Okay. So we now in here. Okay. So let's see the example one. So there's an item A. You can get 1,000 US dollar tomorrow with 100% probabilities. And there's item B. So this item B is risky one. Item A is there's no risk about the future cash flow. So this is the risk-free. And B is risky. The reason is that you have 1% of probability to get 100,000 tomorrow, but you have 99% probability to get 0. So for item B, the expected value of item B is the weighted average of the future cash flow. The future cash flow can be 100,000 plus 0. And the weight is the probability. So 1% to get 100,000 and 99% to get 0. So the expected future cash flow for item B is 1,000. Okay. Now just compare A and B. A is risk-free asset, and it can provide you 1,000 US dollars with 100% probability. Item B, the average or the expected future cash flow is also 1,000, but there are two probabilities. One is get 0, another one is get 100,000. Okay, think for a while and tell me which one you're going to choose. Okay, I think you already made your decision. So if you prefer item A, that means that you are, so if you prefer item A, that means that for the same level of expected return, you prefer lower risk one. Okay, so this is risk averse. Investor will prefer A. And how about risk lovers? So if you are risk lovers, so you prefer B. Okay. The reason is that even though A and B, they have the same expected return or in other words, the expected future cash flow, you prefer the risky one. So if you are risk lover, you will prefer item B. And the remaining one, I think it's easy to imagine that as long as they have the same expected return, they are indifferent between A and B. So they have the same, they can bring the investor same utility or satisfaction. So this is the risk neutral. Okay, let's go to the next example. Item A, you have 100% to get 100 US dollar with 100% probabilities. Item B, you get 1% to get 100,000 tomorrow, but 99% probability to get 0. Okay, let me change a second. Maybe it's more. Please allow me to change. Okay. Can you, sorry, please change the second to item B to 10,000. So in this case, the expected future cash flow for A is 100 with 100% probabilities. And for B has a 1%, 10,000, 99%, 0. So the expected value of B is 1% times 10,000 plus 99% times 0, then it's also 100. So again, item A and B, now they have the same expected return or the same future cash flow. Now consider for a second, so which item do you prefer now? Okay, so I think the conclusion is unchanged for if you prefer A, then you are risk averse. If you prefer B, you are risk averse. If you are indifferent between A and B, then maybe, so in this case, you are risk neutral investors. But the point here is that I think in the previous one, most of you would prefer item A, or in other words, you are risk averse investors. However, in this setting, I guess some students must change their risk preference. They might go to item B. The reason is they are affected by the future's cash flow because it's only 100 US dollar. Maybe some student would like to take this risky item B because if everything goes very well, if you are lucky enough, you can get, okay, you can get 10,000 US dollar. So this means that sometimes investors are risk averse and sometimes they are risk lovers. Okay, let's see the final example. So for item A, there is a 70% of chance of losing 1,000 US dollar. And there's 30% of just, there's no gain and no loss, it's 0. So in this case, the expected return for A is 70% times then the expected value is around minus 700, and item B is something like this. There's no uncertainty, you're gonna lose 600 US dollar. So you might feel kind of strange about this setting. So you can imagine that the current market, the financial crisis happened, the current market is kind of declining. So in this case, you are facing a trade-off. So if you sell the stock right now, your loss is 100% for sure, is minus 600. However, you might think that, maybe tomorrow stock price might rebound, might recover. So let's say that stock price might go down by minus 1,000 US dollar tomorrow. And maybe stock price might go kind of rebound to just the level of stock price, which means you have no loss, no profit, or 0. So in this case, you need to make a decision whether you want to wait for the market recovery or you want to sell the stock right now. So if you sell the stock right now, you're gonna lose, the loss is minus 600. If you don't sell and choose to wait, the expected loss is minus 700. But you have a chance to just balance off So there's no loss and no profit. So which one would you choose? I will give you a second, or you can pause the video and think for a while. Okay, again. So I think for the most of time, we investors are generally risk averse. However, sometimes when the stock we have, the price substantially decline, we just don't want to sell. Okay, we just wait. We kind of holding the stock for a very long time and hoping that the stock price might rebound in the futures. So in this case, you are risk-taking investors, okay? Because you obviously taking the risky strategy. So I think through these three examples, I think you can already have clear understanding about each kind of investors. So next thing is to summarize, okay? Sometimes you are risk averse, sometimes you are risk lovers. And when there's a high probability of losing money in the bet, people are more likely to take the risk instead of choosing 100% probabilities. And the takeaway from the videos is your risk preference will definitely affect your investment strategy. And in the warming up section, we discuss this principle, right? If a financial asset has higher risk, then it should provide investors higher expected return. And think for a while. So which assumption does this principle stands on regarding investor type? So does this principle assume risk-averse investor, risk-taking investor, or risk-neutral investor? So I think if you think for a while, you can figure out that this assumption, this principle, high risk, high expected return, the underlying idea is based on the assumption of the risk-averse investors, okay, risk-averse investors, because they hate risk. So if you ask them to bear more risk, they will require more expected return to compensate for the risk. So that's the reason why the expected return of any financial asset can be written as risk-free asset return plus risk premium. And then with this risk-averse investors assumption, I think we can tackle the portfolio strategy. A portfolio strategy, I think most of you have heard about that. You don't want to put all your money in just one basket. So the portfolio strategy means that you are trying to invest on different type of financial assets. For example, in this case, you might invest in the US large stock. You might put some money in the non-US stock. You might also want to include some risk. So I think stock is very risky relatively. You might want to also include some less risky assets like the bonds. Okay. So this is the image of portfolio strategy, and what we're going to discuss in this portfolio strategy is that how can investors make or design their own portfolio strategy based on their risk preference. Okay, I think that's the end for this video lectures. So thank you so much for your time. So please finish watch the short video I just show you, and also do the survey. Okay, so see you next time.